Booking for profits while stock trading is like finding your way out of a maze. There are so many options that you can take and so many doors that you can walk through, but you need to walk through the correct way to find the way out of the maze. This is a similar situation with stock trading. There's so many parameters that you will need to consider. Sometimes one parameter will override all your analysis and you might not be able to reach your target. So this section gives you more clues about what prods stock prices up and down. You will be able to solve the puzzle. You will be able to go through the maze and find your exit out of the maze by booking profits. We are now examining the movement of stock prices during Monday, the first 15 minutes of the morning time. Over the weekend, traders and investors make decisions for their weekly and monthly trades. The first 15 minutes, therefore, sets the trend. This is the time when you can decide to go long on bullish stocks that take a positive breakout and go short by partly selling some of the bearish stocks in your portfolio. These stocks are taking a decided negative breakout. The morning time is so volatile that you can actually see the change in prices within moments. Make the Monday analysis for the week by taking your journal and noting down the bullish stocks that have risen during the first 10 to 15 minutes. Do the technical analysis side by side and according to the risk and according to your budget, choose some stocks and buy them by the end of the day. You will find that the prices will stabilize for some time, as usually the trend observed on Monday will continue on Tuesday also. It is Wednesday and Thursday where there will be some fluctuations in the prices. Then on Friday, you can book your profits. The advice here is to hold on to the stock for at least a week or 2 weeks until your target. Booking profits on bearish stocks starts by identifying the major bearish stocks in the market. Take your notebook and make a list of these major bearish stocks. After that, you will have to make some more analysis and identify which of these stocks are undervalued. The prices are bound to pick up in undervalued stocks in case you buy them. From the index readings, take a dashboard of the first 15 minutes on Monday. The lower range of the first 15-minute Monday is the stop loss. At the end of a financial quarter or a financial year, you can also see stock markets becoming quite volatile, with the share prices of some companies reversing direction. This is because institutional and retail investors often rebalance their portfolio at these times, looking to see which of their investments have performed well. If the share price of a company they have invested in has experienced a particularly strong uplift over the period, they may decide to take profits and sell the shares. This can push down the company's share price. If the share price of the company that they have invested in has experienced a particularly sharp fall, they may decide that the company is now undervalued and decide to buy the shares while prices are cheap. This can push up the company's share price. Towards the end of the tax year, many investors sell stocks that have declined in value throughout the year. This is so that they can claim capital losses against their tax bills. It tends to push such share prices down temporarily. Share prices are often rallying ahead of long weekends and 3 days holiday. They also tend to experience their biggest fall of the week on a Monday and the biggest rise on a Friday. This is what we have already found out so far. But one thing to note is that this factor may not be the only overriding factor and should not be considered as the only one factor that you base your trading strategy. Volatility occurs as there are fewer or more traders in the market. Traders do tend to do technical analysis and so tend to buy and sell at the same time. Stock markets tend to perform well in January, as this is when many investors have fresh capital to invest in shares. A popular stock market saying is that as goes January, so goes the year. This refers to the historical studies showing that when the Standard & Poor 500 rises in January, it is far more likely to be up over the entire year than when the index falls in January. Share prices tend to fall over the summer months as big traders go on holiday and sell high-risk shares, and this tends to push their prices down. This has led to one of the most famous stock market saying, "Sell in May and go away, don't come back till St. Leger's Day." St. Leger Day refers to the date in early September when a famous horse race is run in Britain. It is always better to be an investor and not a trader. Daytime prices are volatile. Even an accurately predicted intraday trend may not be correct. And so intraday trading is not advisable. It's rather advisable to be an investor where you invest in a share for at least a month or 3 months or up till the time that you prefer.